good day to Miss. We are Group 34. I'm Qing, and I will in charge of introduction for these presentations. The banks that we research in this assignment is the First Republic Bank. First Republic Bank is a commercial bank founded by James Herbert in 1985. It serves wealthy clients and provides specializations in financial services. With the headquarters in San Francisco and offices in New York, California, and Boston, the bank specializes in private banking, wealth management, mortgage, and real estate lending services. A relationship-based model of banking drives its low interest rate environment and was scaling up. However, First Republic Bank suddenly collapsed in May 2023. One of the most significant bank's failures in recent U.S. history. Several financial risks, including liquidity risk, systemic risk, and idiosyncratic risk, influenced the breakdown of the bank. One key weakness was the heavy reliance on uninsured deposits. The failures of Silicon Valley banks and Signature Bank in early 2023 lost depositor confidence and raised new concerns about systemic vulnerabilities in banking sector. However, the failure of the First Republic Bank exposed systemic flaws, such as a highly concentrated wealthy client base and significant interest rate risks. The failures highlight the critical importance of the role of risk management and illustrate how effective crisis communications are essential to maintaining public trust within the financial industry. JP Morgan Chase's acquisitions of the bank assets underscore the importance of maintaining stability during financial crises. In this report, we will analyze the cause of First Republic Bank's failures and the related risks, evaluate the solution implemented by management in response to the crisis, and provide recommendations to the strengthen future risk mitigation strategy.
Hi everyone, I'm Ming and I will be discussing the key causes behind the failure of First Republic Bank in 2023, focusing on its heavy reliance on uninsured deposits and the associated risk, which is liquidity and idiosyncratic risk. To start, let's talk about the cause, which is the heavy reliance on uninsured deposits. Over 60% of the First Republic's funding base came from uninsured deposits, with funds exceeding the FDIC coverage cap of $250,000 US. This reliance worked well during stable times, but left the bank highly vulnerable during financial strain. Uninsured depositors, being highly sensitive to financial confidence, tend to withdraw their funds quickly in time of crisis, amplifying liquidity and idiosyncratic risk. Now let's examine the first major risk, liquidity risk. This occurs when a financial institution lacks sufficient liquid assets to meet payment obligations. In the first quarter of 2023, First Republic faced a staggering $100 billion in deposit outflows as panic spread among uninsured depositors following the collapse of Silicon Valley banks and Signature Bank. Uninsured deposits are not federally backed, making them more susceptible to market volatility and depositor confidence. Adding to this, the bank's business model depended on long-term low-interest loans like jumbo mortgages. While profitable in stable markets, these assets become illiquid and devalue as interest rate rose. When depositors rushed to withdraw, the First Republic didn't have enough liquid assets to meet this demand. Selling long-term assets to generate liquidity would have resulted in substantial losses, worsening its financial position. The second risk is idiosyncratic risk, which stems from the bank's specific business model and depositor base. By targeting wealthy clients, First Republic concentrated its risk in a demographic with deposits often exceeding FDIC insurance limits. These clients were quick to withdraw their funds at the first sign of trouble, further destabilizing the bank. Moreover, the bank reliance on long-term low-interest loans left it particularly vulnerable to systemic shocks, such as rising interest rates. Without a flexible business model or timely corrective actions, First Republic couldn't manage the compounding liquidity and idiosyncratic risk. In conclusion, the failure of First Republic Bank highlights the dangers of over-reliance on uninsured deposits and the need for robust risk management strategies to address both liquidity and idiosyncratic risk. That's all from me. Thank you.
Hello everyone, my name is Qing. and I will discuss the second causes and their related risks, starting with interest rate increases. So, First Republic Bank experienced significant growth during a period of historically low interest rate by offering competitive mortgage and superior services. This attract the high net worth clients. By the end of 2022, it had amassed over 200 billions in assets, most of which were long-term and also fixed-rate mortgage from when interest rates were near zero. However, as inflation rose, the Federal Reserve began hiking interest rates in 2022. The federal fund rate surged from near zero in 2020 to 5.5% by 2023. This sharp rise has a significant impact on long-term asset value, causing them to plummet. Now, let's talk about interest rate risk. When interest rates rise, the value of fixed rate security decline because holding them become less attractive compared to new investment with higher returns. This means that First Republic Bank portfolio of mortgage and securities become a substantial financial burden. By early 2023, the bank had unrealized losses exceeding 13 billion, wiping out much of its 17 billion equity base. This left the bank exposed to significant interest rate risk, and the lack of financial hedging tools like interest rate swaps worsened the situation. Highest interest rate also increased financing costs, reduced loan demand, and further pressure profitability. The failure to diversify revenue streams and the decline in asset value demonstrate how rising interest rate can destabilize even credit-worthy financial organizations. This highlights the importance of effective risk management, especially in volatile economic conditions. That's all from me. Thank you for your time.
So hi everyone, so my name is Ngoh, and I'm representing the third cause behind the collapse of First Republic Bank, which is the contagion effect within the banking sector. Rapid interest rate hikes by the Federal Reserve placed significant stress on mid-sized and regional banks, which were less equipped to handle large withdrawals or asset devaluation. The failures of SVB and Signature Bank exposed vulnerabilities in banks that rely on uninsured deposits, increasing market scrutiny and spreading fear among investors and depositors. This domino effect of uncertainty was reflected in the sharp decline of the KBW Regional Banking Index, which tracks mid-sized banks, showing a drastic loss of confidence in the sector. Right, so in this case, it is actually exposed to systemic risk, implying the cascading failures in financial system due to the interconnected vulnerabilities, which significantly contributed to First Republic Bank's downfall. The bank's high reliance on uninsured deposits and sensitivity to interest rate changes reflected to the weaknesses of SVB and Signature Bank. This price collapse heightened the market scrutiny, eroding depositor confidence and creating severe liquidity challenges for First Republic Bank. Competitors attracted depositors with better returns, further isolating the bank. The intense market pressure combined with systemic weaknesses turned localized failures into widespread financial instability. The credit rating downgrades were also one of the key causes for the collapse of First Republic Bank. Agencies like Fitch rated it from A- to BB, while according to S&P Global, its rating dropped from A- to BB+, reflecting concerns over its ability to withstand financial pressures caused by declining asset values and also the rising liquidity risk. These downgrades weakened investor and depositor confidence as well, accelerating mass withdrawals. Furthermore, First Republic's similar business model to SVB and Signature Bank heightened public concern as well. This perception of risk, combined with declining ratings, worsened the bank's situation and undermined its financial stability, compromising clients' confidence. With the cause mentioned, it poses credit risk to First Republic Bank, where it means that the likelihood that a borrower cannot meet financial obligations. The downgrade signaled greater risk to investors, increasing borrowing costs and reducing funding options. Emergency measures like borrowing from the Federal Reserve discount window added to financial strain due to the higher rates interest charge. Poor ratings damage relationship with counterparties, leaving the bank unable to secure affordable funding. The loss of depositor confidence further depleted liquidity issue, compounding financing costs and making the bank more vulnerable to collapse.
Hi everyone, I'm Tsugang, and now I'll be presenting the solutions and recommendations to address the challenges faced by First Republic Bank. This focuses on 4 key areas, which is diversifying the client base, government interventions, strengthening risk management, and improving transparency. First, First Republic Bank relied heavily on wealthy clients with uninsured deposits, causing instability during the crisis. To mitigate this, the bank should target SMEs, middle-income individuals, and retail depositors who maintain insured deposits. For example, during the 2008 financial crisis, Citigroup reduced reliance on corporate clients by expanding its retail banking division. Diversification lowers concentration risk and ensures no single client group destabilizes the bank. Moving on, government action is essential to prevent contagion effects like those caused by the collapse of SVB and Signature Bank. Temporarily increasing deposit insurance limit to cover all deposits can reassure depositors and prevent withdrawals. The UK government used the similar strategies in 2008, guaranteeing 100% of deposits at Northern Rock, effectively stopping bank runs. The US government could also adopt a comparable approach to restore depositor confidence. Besides, improving risk management and liquidity strategies is vital. Poor liquidity management and reliance on external borrowing worsen the bank's instability. First Republic can adopt Basel III liquidity frameworks and stress tests to improve resilience. During the COVID-19 pandemic, JP Morgan Chase maintained high liquidity coverage ratios, allowing it to withstand market volatility. Implementing similar strategies can help First Republic better manage withdrawal pressures. Lastly, transparency is crucial during crises to restore confidence. First Republic should provide regular updates on its financial health, recovery plans, and collaborations with regulators. This builds trust and stabilizes corporations. Clear communications reassures stakeholders and mitigates panic. In summary, these recommendations offer a comprehensive approach to stabilizing First Republic Bank and ensuring future resilience. And that's all from me. Thank you.
Hi everyone, I am Kuizer. I will discuss the effectiveness of First Republic Bank's management team during its financial crisis. I will highlight two major funding strategies they employed to avoid collapse and analyze their outcomes. The bank's first strategy was borrowing heavily from institutional lenders such as the Federal Home Loan Bank or FHLB and the Federal Reserve's discount window. In 2021, the bank borrowed 3.7 billion from FHLB. By the end of 2022, this amount was increased to 11 billion. In the first quarter of 2023, it had increased to 28.1 billion. Similarly, borrowing from the Federal Reserve reached 93.2 billion by early 2023. However, after a credit rating downgrade, the bank's borrowing ability was drastically reduced to just 5.3 billion. While this borrowing provided short-term liquidity, it came at a high cost. The increased reliance on external funding strategies significantly raised expenses, weakened profitability, and contributed to the bank's financial instability. The second strategy involved seeking deposit from other banks. On 2023 March 16, First Republic Bank secured a 30 billion capital infusion from 11 major US banks, including JP Morgan Chase, Bank of America, and Citigroup. This move was intended to address liquidity issues caused by significant customer withdrawals. However, it wasn't enough. One critical problem was the bank's liability to deposit ratio of 111%. This means the bank had lent out more money than it held in customer deposit. This over-leveraged position made the bank a risky bet for both investors and customers. Now, let's evaluate the effectiveness of these strategies. Although the heavy borrowing and capital infusion helped improve liquidity in the short term, they ultimately worsened the bank's situation. Borrowing raised costs and reduced profitability, while the credit downgrade further limited access to funding. The 30 billion capital injection failed to restore customer confidence. Instead, continued withdrawals exposed the bank's over-leveraged position, unsustainable liability to deposit ratio, and poor risk management practices. Ultimately, these strategies treated the symptoms of the crisis rather than the root causes, like weak governance, structural fragility, and insufficient capital buffers. These mismanagements led to the bank's failures.
In conclusion, the collapse of First Republic Bank in 2023 was mainly due to the ineffective internal risk management and the dependency on uninsured deposits from wealthy clients, and its allocation of resources to long-term fixed-rate assets created a lack of diversification, leaving it vulnerable to liquidity, credit, and systemic risk. Despite efforts by the management to respond to the crisis, the structural weaknesses embedded in the bank's framework hindered recovery. To address them, First Republic Bank could have diversified its depositor base by targeting smaller businesses, retail customers, and middle-income individuals with insured deposits, thereby stabilizing its financial standing. Additionally, the implementation of robust risk management frameworks like Basel III, proactive government intervention to extend deposit insurance limits, and enhanced transparency in financial reporting to restore depositor confidence and credibility could be implemented. Ultimately, these measures highlight the need for banks to adopt a more diversified and resilient financial structure to navigate market volatility and ensure long-term sustainability sustainability in this ever-changing financial landscape. So that's all from our presentation. Thank you so much.